So the economy is about to go off a cliff, and I don't think the market is yet prepared for it.
Hey guys, welcome back to Library of Wealth. Today we have ex-hedge fund manager Raoul Pal on the current state of the crypto market. Raoul Pal says that this next cycle will be institutions who will misjudge the volatility of the market. He says that everyone who comes into these economic conditions will have to take it on the chin a few times to understand the variability of the space. He talks about the familiarity he has with the fluctuation of the industry and how he initially underestimated the massive opportunities available. Let's listen to this interview with Raoul Pal as he talks about what's coming for cryptocurrency in the next 30 days and how it will directly affect market conditions. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
Let's see what happens. But the next couple of months, I'm expecting it to be signaling a full recession, and we'll get to the tipping point where bond yields start to fall. It'll start affecting asset markets. So I'm not a believer we go to new lows. I've done surveys after survey and seen all the surveys on Twitter. 70% of all respondents in crypto and macro think equities go to new lows. Now, if that is the case, then most people are positioned for it. So therefore, the path of pain is the opposite. And I think the market's priced that in. My big picture thesis is, from my forward-looking indicators, I do a lot of work for Global Macro Investor and also in Real Vision Pro Macro, two of my research services, on the global business cycle. And I particularly focus not on the data that's out today, where we are in GDP growth, but where we're going in inflation, where we're going in unemployment. My forward-looking indicators, which are like financial conditions that I've built based on the rate of change of the dollar, the rate of change of interest rates, the rate of change of commodity prices, from whether it's PPI, there's so many things, they are pointing to the fastest deceleration of data that I think I've ever seen in the shortest period of time. So what we're facing is a recession, which most people know, but I think the speed at which it happens is much faster than people expect. So we're starting to see some of the regional Fed surveys falling apart. But what I'm really looking at is the ISM survey, the Institute of Supply Management. That's a survey of basically buyers in large corporations and industrial companies about how they see conditions. They tend to do a very good job of tracking the business cycle. GDP follows it. Now, there's this magic number, which is 47. 47 is the level at which it has a 100% chance of recession. Now, we're still in the 50s, low 50s, but all of the forward-looking stuff is going down to 47 for the shorter term stuff, i.e. the next couple of months, we should go 47 and maybe below, maybe 45. But the forward-looking stuff gets down as low as 35. So we're talking negative 2.5%, negative 3% GDP prints. And it should be bottoming by my work by about February, March next year. So the economy is about to go off a cliff. And I don't think the market is yet prepared for it. So let's go back to this Jackson Hole thing. What did they tell you? They didn't tell us anything new. They said, we really want to get to 4% and hold it there depending on the data. Well, the bond market, if I look at euro dollars or Fed funds, they're already at 4%. So the market's priced that. So there's nothing new. So I think, okay, there's nothing new there. So if the economy starts getting weaker, because the Fed said they will be more data dependent, then we'll see the bond market starting to price in lower rates in the future. So I'm looking at that. And then the Fed said, well, they will change their mind if inflation comes down a lot and unemployment goes up. So the forward-looking inflation data is already falling fast. My work suggests it could go negative in 18 months, which is something I've been talking about a while when I've been looking at, for example, the example of 1947, when people all came out of World War II, went back into the labor force, much like the pandemic. We had no supply because nobody was making everything because everybody was at war. We had this, prices went up 20%, 18 months later, negative 3%. Then it had a rebound effect and then balanced out. I think we've got something similar playing out now, which is contrary to the narrative that we've got sticky inflation. Everyone looks at the 1970s, that's what we're doing again. Unless the Fed crush it, they're Arthur Burns, and we're going to ruin it. Well, in the 1970s, we had this massive demographic boom that kicked in just at the wrong point, which was the baby boomers entering the workforce. We have the opposite. We have, in 2023, the record peak number of people hitting 65 in the US labor force. And that means peak retirees. So we've got peak retirees happening, and we've got demand destruction driven by this economic cycle. So the forward-looking inflation data to me looks like, if I look at commodities, I look at a bunch of things like new orders versus inventories in ISM, that they go negative. Okay, that's the extreme. That's actually my base case. Maybe I'm wrong, but inflation's coming down significantly and very fast.
Raoul goes on to say that in his macro view, we are in fact headed for a worse recession, not just in the cryptocurrency market, but in the stock market as well. He believes it could be pretty bad initially, saying that the Fed shouldn't have done what they did, but the bond market tightened for them anyway. The Fed are going to have to unwind it, and it could get messy. Using all the technical indicators that Raoul uses, his view is if we are going to reach a proper bounce or a low, it happens at the end of the year. And between now and then, everyone is likely to panic.
So the next part is the employment question. And again, when I look at forward-looking employment stuff, just the housing surveys alone, housing is the 5th largest employer in America. It looks like that they will start laying off workers pretty fast because they've got massive inventories. Everybody from Amazon to Walmart said we've got too much inventory. They're all laying off staff. Everybody's starting to lay off staff. All the tech companies are laying off staff. So I think we're going to start to see unemployment and inflation falling, the economy falling sharper than people expect. We're already seeing oil weak. We've seen all the commodities weak. Many of them are now negative year on year or close to it. So we've got this storm where bond yields are still high. They're actually, most assets year on year map the ISM really well. It's amazing. The business cycle is like this voodoo magic. And many people can see my threads on Twitter. I write about this a lot. I talk about it in Real Vision a lot. Is the year on year rate of change of the S&P, the NASDAQ, the bond yields, copper, oil, emerging markets, credit spreads, that all map the ISM. So right now, where are asset markets pricing? Well, interestingly, bond yields are pricing the ISM at 63. So they're way above where the market...
What does that mean, Raoul, for people who don't follow fixed income and ISM?
It means that the bond market is pricing inflation plus growth way far higher than the ISM survey itself. Now, okay, but that's not consistent with anything else. The S&P is pricing it at 45, full recession. The NASDAQ, 42, bigger recession. Growth technology stocks, 35, big recession. Copper, 45. The dollar, which year-on-year rate of change also maps, is pricing growth at 40, or just below 40 now. So most asset prices are pricing in a sharp recession. The bond market is not yet doing so. The only other one that's lagging is oil, which is in line with current ISM and not future ISM. Everything else is pricing future ISM, i.e. recession. Oil's not pricing in a recession yet, and the bond market's kind of in la-la land.
If the central bank reaches the inflationary threshold, Raoul feels the Federal Reserve will have to intervene. Many analysts feel that the current banking system is on the verge of a collapse, and that the fiat currency world will have to make a major adjustment, or else it will ultimately come crashing down. Raoul says he still sees the bull market ahead, but until we see what happens in the crypto market in the next 30 days, we'll have to wait and see. What do you think about Raoul Pal's interview on the crypto and financial markets? Comment down below. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.